Hey guys, welcome to the Sound Banking Podcast. This is your host, Kyle Reese, and the other host or co-host, Raymond Ward. We've been recording podcasts for a couple months now, and we just appreciate all of you guys who've been listening. Today, we wanted to take a little bit of time to talk about dividends and kind of what are they, where do they come from, what's the impact of them, how can you utilize them, and invariably, when we do have conversations about dividends, the direct versus non-direct recognition always comes into the conversation with clients, with other practitioners, and we'll get into that a little bit today. But ultimately, we just want to provide the information for you guys. This isn't meant to be an all-encompassing training or anything like that. We're just having friendly conversation about dividends and the benefits of them to us and to you guys as policyholders. So, Raymond, you want to tell us kind of your thoughts on dividends, or just kind of take it from here?
Yeah. Thank you, Kyle. I guess I'd start off by just saying, understanding dividends. I know I'm going to guess that most people understand it, but maybe not everybody. So just say you're an owner of a bank. Okay, we're talking about banking. Literally a bank, brick and mortar building and all that, and maybe you're a member of a small town bank, and every year or every quarter, whatever they decide, you are given a dividend, which is in a sense part of the profits. When I say part of the profits, I mean this part of profits has to go to paying salaries and paying the electricity and all the plumbing and and all that kind of stuff. But you get a dividend every year. So for being an owner, there's stocks out there. You can do the same thing. But inside the policies that we're talking about with whole life mutual insurance companies, mutual meaning that you are an owner of that company. So the same scenario plays out here, that you are going to get a dividend. Now, in terms of the IRS and all of that kind of stuff, we don't want to call it profit, but we'll call it that it's a return of premium, I guess. You can, this is all kind of semantics, but you could talk about it in terms of profit if you wanted to. But you are given a dividend at the anniversary of your policy every year for, this is not a guaranteed, if you look on the illustrations, you'll see that it's not a guaranteed event, although the mutual insurance companies that we deal with have all been around for over 100 years. And every single year they pay a dividend. And so, you can kind of lean on the fact that you're probably going to get it, most likely. So it's part of the return of premium, in the sense that the actuaries / engineers, if you want to call them, that have engineered the profitability of the business in such a way that they underestimate their investments and overestimate overestimate their expenses. And so you end up with a dividend every single year because they're being very conservative. There's no fractional reserve inside of banking and all with the policy and all that. That's dollar for dollar investing, which is sound, in my opinion, sound money floating through the company. So what do you think, Kyle, from what I've said? Where would you like to take it from there?
No, that's really great. I appreciate you kind of bringing up that topic and explaining really what is the dividend. It's just a portion of the profits of the company. And I just want to clarify for everybody who's listening, they are the profits of the company. Okay, the dividends represents a portion of the profits of the company. Whether the IRS classifies them as profits or not is a completely different thing. The IRS views it as a return of premium, which makes it not taxable until your dividends exceed your total outlay. But your which always happens, isn't it funny? Eventually, your dividends are going to exceed what you've ever put into the policy. It's so awesome. But from a banking perspective, an ownership perspective, it's the profits of the company. You're a part owner of this company. The way I like to talk to my clients about it is, uh, we've got stock life insurance companies, or publicly traded life insurance companies, and then we have mutually owned life insurance companies. And in both companies, the customers are the same. The customers are the policyholders. It's just that as you go down into the ownership category of those companies, the mutual company is owned by the policyholders, and the stock owned, or the publicly traded company is owned by the shareholders. And so it's really fun to look into that, and really be able to understand why dividends are so important. um, or I should say, why working with mutual life insurance companies is so important, is because you're an owner and a customer of the same exact company, and that makes it very easy for them to do right by the owners and the clients or the customers, because it's the same individual. Makes it pretty profitable.
Mm.
Um,
Yeah.
and you mentioned, the companies we work with have been around for over 100 years. I don't even entertain companies that have not been around or been paying dividends for less than 100 years. Like, it's easy. That's an
Right.
easy decision, right?
Yeah.
I want longevity when I'm looking at building capital for myself. I want to make sure that company has a history of being profitable for a long, long time. And so I work with companies that have been over 100 years of paying dividends, not guaranteed. They've been paying dividends, though, for over 100 years every single year. They've not missed a year. That includes
Mm.
through the Great Depression, through 2008, through everything in between. They've paid dividends. They've been profitable. When we're capitalizing with a company, that gives me a lot of peace, right? And so, um,
Right.
the
Yeah.
it's funny because you look at the arguments from from entertainers out there, financial entertainers, where they say, uh, you're not actually making money, you're not actually like profiting, you're just getting a return of premium because you overpaid premium. I'm like, yes, you if you want to look at it, that you overpaid premium, you're contributing to the health of a company that's been around for over a century and knows how to navigate the most gnarly financial setbacks that we've ever even heard of. Like,
Right.
why would
Yeah.
you not want to contribute to that?
Yeah. Yeah. If you think about it, like a business owner, entrepreneur, um, many times they'll take a lower salary so that more of the profit will go back into investing inside the company. Now they
Mm-hmm.
could, just say, for instance, they take 50,000 instead of taking 150 that they could have taken. Um, and so they're being conservative as well, so the company will grow faster sooner.
Mm-hmm.
And likewise, that's a really smart idea. But later on in time, in the future, then they'll know that they'll be able to take the 150 or more, because the company has done so well. And the same thing happens inside the insurance company, that they are being very conservative. Now, granted, they're giving back parts of the profit that are growing our policies and all that, but their company is strong and
Mm-hmm.
growing, because they're being conservative. It's it's. I've had a number of companies I've started, and I've sold one, and all that kind of stuff. And you want to be conservative, especially in the beginning. I mean, it's a lot of sweat equity.
Oh, it
Um,
is.
so, so you touched on something about the dividends catching up, and surpassing what we're putting into it. the the dividend, the only time the dividend becomes a problem is if you're taking it in a check, let's say, from the policy, and you go beyond the basis point, which is what the total amount is that you've actually taken out of your pocket and sent to them.
Mm-hmm.
um, but because of the design of the policies, the dividends can and will, as you have already pointed out, grow beyond what you're sending them each year. So you send them 10,000 annually or whatever. There's going to come a point when you're sending 10 and the between the dividend and the cash value growth inside the product, it's going to totally outstrip what you're sending them.
Yeah, but
Which
even
is
if we look at the dividend itself,
yes,
outside of the cash value growth within the policy, if you're sending 10,000 a year to the policy,
yeah,
there comes a time when you're getting 20, 30, $40,000 in dividends each year. I mean, it's not right away
just
necessarily.
yeah,
Not
yeah,
by
just the
it's actually not
dividend.
right away. Yeah.
Yeah, it's not right away, but you're right though. 20 years down the road, just the dividend, hence the dividend paid up, if you want to use that as an
Yeah.
option,
Yeah.
exercise that right to do that. Um, and also that the dividends, so you could take them, you could have them send that check to you the
Mhm.
first year you could, but that wouldn't be an IBC design. The IBC design, the non-forfeiture, decision is to say, I'm going to send that dividend back to the company. That's a true IBC, policy, is to help that whole thing just become a machine, so to speak. Um,
Right.
yeah, yeah,
Yeah, so you could do multiple things with dividends, right? You can take them and reinsert them back into PUA, and I think we talked about that. I don't know, a couple weeks back
yeah.
on the way that cash value grows. Dividends are they create a lot of compounding growth when you take them and put them back into PUA because you're buying a lot more death benefit for the dollars that you're actually putting in there.
Mm-hmm.
Um, and so you could do that. You could put the dividends back into the policy. You can take dividends, and let's just say you had a business startup, cost you 100 grand. You've been capitalizing your system for a little bit, and you want to take those dividends and you want to start paying loans back with them. You can do that if you
Yeah.
want to, you know. um, but there is there's negative ramifications, right? There's pros and cons to everything, but there are some cons as we look at the IBC style. Like, what is the impact of taking dividends and paying off loans? Um, it can be kind of severe,
Mm. Yeah. Yeah. Instead of paying back the loans out of your pocket, so to speak.
right?
That's what you're referring to.
Mm-hmm.
Yeah, yeah, yeah. Because and I know there's an example in the Becoming Your Own Banker book. Nelson illustrates the I think it was the auto lease or something like that, or purchase, um, that that he illustrates taking dividends out. I think it was, um, and in a sense he wishes he hadn't done that, shown that, because people might tend to want to do that. It's
Mm-hmm.
best to just pay back the loans, um, through the ability to save, if you will, and sending it back to pay those loans.
Well, let's talk about that for a second. Why? Like, let's just say the dividends going to the PUA for a second doesn't even matter. Why would you take, I should say, it doesn't create compounding. Let's say it doesn't create compounding to take dividends and put them into PUA and generate more cash value. And that it's just an even, like, it would be the same thing as taking dividends, putting in your pocket, as it would be if you took dividends and put it back into the policy. That's not what happens, but let's just say, we're comparing apples to apples here. Why would it not be in your best interest to take dividends and pay loans back versus paying them out of pocket?
Hmm. I think you're going to have to answer that yourself.
Well, I just thought of this, so maybe it would be the wrong answer. um,
Yeah. Why
I
would you? This is okay. This is
yeah.
hmm. That's an
So
interesting thought
and
process.
obviously dividends create compounding within the policy,
Right.
so it's kind
Right.
of hard to remove that fact. But when you go down this process of becoming your own banker, you have to separate the two entities. We've talked about this a couple times already. You have your banker self, and then you have your consumer self. Well, the bank is, you're capitalizing your banking system, and dividends are a profit for that banking system, right?
Yep.
Okay.
Yep. Yep.
Who did your bank provide the loan to? Provided it to the
You
consumer self,
yourself.
right?
Yeah. Yeah.
Right. Now, if you take the bank's profits and pay your loans off, your consumer's loans off, who's paying the loan? Is it the banker self or is it the consumer self?
Is it it's the consumer self because they would have been, yeah, because it was their dividend.
It's the consumer self who should be paying the loans, right? That's
Yeah.
who should pay those loans, who should pay that interest back to the insurance company. But the banker self is taking their profits and paying the loan off for the consumer. If you look at it like that, if you take the dividends and just
Yeah.
pay loans back,
Yep.
then really you're not experiencing, as a consumer, you're not experiencing the impacts of taking a loan. That goes against everything in becoming your own banker. You know, we if you're going to make a loan, if you're going to take a loan, you've got to pay the consequences for that. Period. I mean, that's just the way the world works. There's always a cost
Right.
of money. You
Right.
always pay your loans back. But if you make a loan, if you take a loan from your own banking system and you can't pay it back, so you use dividends to pay it back, you're ingraining a thought process that you can get something for nothing.
Yeah. The other, yeah. Yeah. You're thinking you can get, yeah. And, everybody's looking for that, something for nothing. Uh, but the other thing is that if you, if you were to just let the dividend go into the policy without it buying PUA, and it was just going in, it was going
Hmm.
in as cash. Basically, it's going in as cash.
Right.
It's gonna it's gonna automatically uh, become part. I guess I want to say it'll become part of that cash value that is growing in itself.
Right.
You wouldn't. It's all. I guess if you're going, because this is how you phrased the question, was if you didn't put it in as a PUA, it goes in as cash. It's going to grow anyway, but the 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 opposite side of it, or the other way, if you buy the PUA side, you're fully paying up that um, little contract that you just bought in
Hmm.
full, and that's going to grow. So
Right.
I guess in a way, I think of it as it's yeah. This is a really good question, Kyle.
And
You,
maybe I shouldn't have even asked it because
no,
it's
I
so
think
unrealistic.
no,
Like,
I
no,
think
that it doesn't happen,
yeah,
right?
yeah, yeah. It does. Well, it doesn't happen in the policies, but something for nothing. That's kind of what you're getting at. That even if you just do that without the PUA, that cash, it's money, it's
Hmm.
cash going back into the policy, which is attaching itself to the cash value, which is part of the whole mechanism that grows this policy because of time, right?
Hmm.
That you're compressing the time. Um, that's yeah. I really like those kind of questions. Like it's almost like an impossibility. It certainly would never happen.
Yeah,
Um,
because ultimately those dividends go back into the PUA and they always create compounding. They buy more death benefit,
right,
and then
right.
your cash value is becoming more and more available to you every single day, just because you're getting older, right? We talked about that a couple
Yeah,
episodes ago. Um,
the time. Yeah.
but and so there's a huge benefit to taking those dividends and putting them back into the PUA. And I guess I was trying to get everything on the same playing field to say where the money comes from, taking those dividends and actually putting them into the loan repayments is really just taking the ownership away from yourself as the consumer. To It's not requiring that you are the one paying the bank back. And I think that's a big struggle for a lot of people in that practice infinite banking, or um, yeah, that practice infinite banking, that have IBC policies. I think it's a struggle to really view themselves as separate entities, as a business owner and as a consumer. If you
Yeah.
don't if you don't fully separate that, all of these other things, they become very gray areas. But if you're able to separate that, you can look at everything in a black and white. It's like, okay, who is paying this loan back? Is it my bank or is it me? I would never expect a bank to pay a loan back that I took out. That would never happen.
That would never happen. Right, right. And the other question you have to ask yourself is, do you want a big bank or do you want a little bank?
I want a very big bank. Easy answer.
Yeah. So because of that, you want that dividend to go buy more life insurance, the PUA paid up, fully paid up. And the other thing is if you just say, for instance, instead of having that dividend go back into the policy, not being a PUA, just like you posed it, but what if you decided, you know what? I just want that dividend. Just send it to me. I'd like that cash. Where's that cash going to go? It's going to go poof.
Yeah, it
Because
is.
it's going to find a home. Something that you'll see something that
Expenses
will.
rise to equal income. Parkinson's law.
Yeah, yeah, yeah. So you definitely don't want to do that. At least not in the beginning.
Yeah.
Some people will take them as they get into their 70s, 80s. They'll take some dividend before they take loans. They'll use it as part of their retirement. And okay, so that's a keep them coming. That was a good question, even though it would never happen.
Yeah.
Yeah.
So we've talked about two things you can do with dividends so far, right? We've talked about purchasing PUA. We've talked about repaying loans. There's a couple more things you could do. You could pay your premiums. You could premium offset, or you mentioned some companies call it dividend paid up, right?
Yeah.
And then the fourth thing is you could pocket them, right? So four major things that are pretty common that you can do with dividends. One of these four major things creates compounding. The other one's just uses that cash flow, for lack of a better word, as something to pay expenses, right?
Yep.
Or just be a
Yep.
temporary benefit.
Yeah. Yeah. I just want to touch on this. So the difference between dividend, there is no difference. It's just semantics again, terminology. Dividend paid up is like you used a different term that I've heard many times. What did you call it? Conversion? No?
Premium offset?
Premium offset, yes. Yeah. So you'll hear that term also, and they are basically the same. So I just wanted to clear that up for who's ever listening, that you hear these different things, and sometimes it's good to just say these actually mean the same thing. So anyway, and then dividends work differently also with direct recognition and non-direct recognition companies.
Mm-hmm.
So we were talking earlier before we get on turned on the recording that I have both. I have a policy with my wife's is non-direct recognition, and my policy is with a direct recognition. There's also companies that will allow you to do either or.
Yep.
So you can choose. I mean, you can be with one company and have different policies, right? Because again, you can have multiple policies. Don't be surprised if somebody says, "Yeah, I have 10 policies," because there's many people that do have. It becomes a system. So there's that option too. If you go with a company that you just want to be with one company, but you want to flip back and forth for different reasons or whatever. So using my wife's policy with the non-direct, she has a variable interest rate when we take a loan, and mine is fixed for that loan. So yeah. So
what's the cap on that variable interest rate?
On the cap, what do you mean by the cap on it?
You can vary. So the company can fluctuate the interest rate, right, with the non-direct recognition. Um, and with the policy that she has, is there a ceiling on how high that interest rate can be?
I believe there is. I'd have to go back and read the contract again.
This this is why it's so important when you're picking companies, is because some companies do have a ceiling and others do not have a ceiling, and that's all within the contract. You got to understand that stuff, because I'll say straight out, I would much rather have a direct recognition policy if uh, and get that fixed rate, if the other option was non-direct at a variable rate with no cap on the bottom or the top. Now, a company that
Hmm.
has a cap on the top and a floor on the bottom, and it can vary anywhere within there, I would rather have a policy that is non-direct recognition for the dividends with the company that has, those ceilings, right? Because then I know what I'm dealing with. Um, and
Yeah. Yeah.
black
Yeah.
and white.
That
Everything
makes a
has to
lot
be
of
black and
sense.
white.
Yeah, that makes a lot of sense. I think I think with her policy, there's a cap. It seems to me floating
It's
around in my. I'll have to check, but I thought it was a 3% um, or 3 basis points one way or the other.
3 basis
Uh,
points one way or the other. So
well, I shouldn't
the
say one way or the other. One way up was what I was really interested in knowing
gotcha.
when we first read. But again, I haven't read it in 5 years, so
Yeah,
I don't.
knowing the company that you have the policy with, or that hers is with, it's an 8% cap. So 8% is the top um, inflation, or it's inflation. 8% is the top interest rate. They cannot go beyond that. And Nelson actually talked about this when he had his policies back in the late 70s during the stagflation time. Um, interest rates were at 23% out there in the market, but he could access capital through his
Hmm.
policies
Right.
at 8%. It didn't go higher than that. Man, that gives you so much peace. That gives you such a position of power and freedom within crazy market situations. The floor is 0%, and so they're never going to be below that. They're not going to pay you to borrow money from them, and really, they're
Yeah.
never even going to be down to 0%, because that's a unprofitable loan at that point. They're not in the business to not make profit.
Right.
So
Right. Well, thank you for that.
yeah, absolutely.
Saved me from going back and having to look at it.
Oh,
So
you're
that
fine.
means that like her loan interest rate, or our loan interest, I should say, is 5%, and so it can only go to 13, which is actually
No, no, no,
comforting.
no, no, no.
Is that what you mean? No.
Nope, nope. It is 8% interest. So if it's 5%
Oh, okay. So
now,
that's
it can only go
three.
up to 8%.
So that is the three. Yeah,
Right.
that's the 3 points that I thought it was. Okay. All right.
Yeah.
Whew. But it was even at 8, that that would be comforting too, because I did live through that time when the interest rates went to 22%, 20 to 22 to 23%. And I wasn't like in a place where I was buying houses or anything like people were doing, but I remember that very clearly. What was the other year in 83, 84, 85, somewhere around there, 85, 86. That's another time that interest rates went through the roof. And I remember guys that were my peers that were at that time were investing in housing because it was exploding. They were making all kinds of money, and they got caught.
uh,
Just like I can think of one guy, and his name was Mike. He was a sheetrock guy, Frenchman. He could lay out a house in sheetrock so fast, it was unbelievable. But he was making tons of money, and then a couple of years later, he was broke.
oh my
He had
goodness.
he had been wiped out. I mean, literally wiped. Oh God, he leveraged everything, you know.
Yeah. Yeah.
Uh,
It's so
yeah.
sad, but that's the benefit of having capital within policies like this is it's a controlled environment, and if you want
Mm.
that fixed rate, go with the non-direct recognition company. And I guess we should clarify for some of the folks who don't know the difference between direct and non-direct. Direct recognition is where you take a policy loan, you collateralize the cash value within the policy, and when the company is paying dividends, they directly recognize how much you have in outstanding loans compared to your entire cash value and everything, and they pay you dividends based on that. And then the non-direct is where the company doesn't recognize your total outstanding loan balance when they're paying dividends. It's like you don't even have a loan balance. It's the same if you didn't take a loan as if you did take a loan, right? And so there's pros and cons, and again, it is kind of semantics because it seems like generally speaking, dividends can be a little bit higher with non-direct, uh,
With
yeah, with
direct,
direct recognition policies, um, because when there is no loan balance, dividends tend to be a little bit higher, and then we have that outstanding loan balance, dividends are a little bit lower, versus the or the non-direct recognition. um, the dividends tend to be a little bit lower on average from a direct recognition
direct.
company. Yeah.
Yeah, yeah.
So it all washes out. Really, it all washes out. Here's where I stand on it: is when I'm taking a loan, I want as few external factors as I possibly can that would make me consider the negative impacts of taking out that policy loan or borrowing money. I want less things to be concerned about. If I know my dividend is not going to change, whether I take out a loan or not, I don't have to think about it. Right? It's just not even a question. And again, it's all marginal. It's not a huge deal, but it's just one more factor that is not needing to be processed when I'm making a financial decision. When we make financial decisions, it's usually like big financial decisions. It's usually a complicated thought process. And so I want to remove as many of those complications as possible. And so having a policy with non-direct recognition tends to help with that.
Yeah, yeah, yeah. I get that. Um, I want to just say that the direct recognition, we're talking about it, that the dividend would be lower, but it's only lower on the loaned out amount.
Right.
It's lower on that. It's not like it's nothing. It's
Mhm.
just lower than the money that is still in there that's not in a loan, that in your cash value. So then you have two things to consider, precisely what you're talking about. You have two things to consider: the portion that let's just say it's $10,000 loan that you have out. That's going to get dividends, but it just won't get the full dividend that the other money that's still left in there is going to get. So there are those two considerations.
Right.
Um, Personally, for me, I don't. That doesn't really concern me. I guess I can quickly justify it, But like I said before, though, I understand that we have two policies, and I can go between either one. It doesn't really matter to me. But I can completely agree with you. The less things that you have to consider, the better. That you can make solid decisions and not be thinking, having to calibrate everything. So,
Yeah. And
yeah.
honestly, for most people, a direct recognition company is really going to be no big deal because you're not going to be leveraging all of your cash value all the time, right? So let's say you've got $100,000 in cash value, you want a new car, maybe you take out 20,000. Your dividends only drop based on that 20,000, and you still have the other 80,000 of cash value in there that's at the full dividends. That's really not a big deal. Someone like a real estate investor, let's just say, that is going to be leveraging the majority of their cash value every time they make a new purchase or a new investment. that might be a bigger concern for them, is if 80-90% of their cash value is all of a sudden dropping in their, the dividends on 80 to 90% of their cash value decreases. That might be a bigger thing, a bigger concern, right? So it's
It,
like, how
it,
much are you going to be using your policy?
yeah, but it also the thing you can't see is what that other investment is going that you're taking that loan for. What is that investment? How is that going to perform that can't be seen inside the policy?
Yeah, I
So
completely
so,
agree. And that's
so
outside of either direct or non-direct, because it doesn't
yeah,
matter what's
right.
happening there. That's a totally separate thing.
Yeah, that you're still you're doing it for well, theoretically you're doing it for a reason that's going to benefit you.
Yeah.
So
Otherwise, you
um,
probably shouldn't do that.
yeah, yeah. Well, can you think of anything else that we should cover? I wrote
N-
down some stuff, but um,
No, I think that's pretty good, Ray. I think that, ultimately for, our listeners, dividends, you want them. That's your profits, right? So do business with a mutually owned life insurance company. And then if you're going to get dividends, if you're going to get profits for being part of a profiting company, um, do the best things with that, right? Take that and go generate more cash value. Go create compounding within your banking system. Don't take
mm,
them to pay expenses.
yes,
If you absolutely have to, then that's fine. I get it. I totally get it. I had a business fail. We had a dry couple of years. I've had to use my policy in ways that not I didn't wish that I would use my policy for in these ways. So I get it. When things go wrong, that's one of the reasons why we have these policies capitalized for, is the
right,
flexibility to use them how we need to use them.
yeah,
But whenever you can, definitely generate more cash value with those, through PUAs purchased by dividends. It's going to help you tremendously.
right, yeah. So yeah, and I had an incident where the new policy owner thought that he might be getting checks, and so I took it upon myself that I didn't. I guess we didn't cover that enough, as I'm sure we covered it, but that you always in from an IBC point of view, that dividend goes back in as a PUA.
Mm-hmm.
That's just the way it is. Otherwise, it becomes something else. But it's wonderful to have the flexibility to say that. The other thing is the dividend paid up process. If you have a down year or whatever, you decide that you're going to, instead of having it go to a PUA, you can have it pay up the premium that's due, and then you can turn it back off and have it go back to the PUA. It's not like you're locked in,
Right.
not like a reduced paid up. Once you do a reduced paid up, you're done.
Yeah.
But with the dividend paid up, you can go back and forth with it. So that's flexibility too, which is wonderful.
Yeah.
Yeah,
Well, thanks, man. This was great. Great to talk about dividends. It's a huge element to infinite banking. And without the dividends, we wouldn't see the level of compounding that we get to see. And again, when you're not part of a good mutual life insurance company that has a lot of years of dividend paying history, you lose out on those. I know they're not guarantees, but you lose out on the likelihood of getting those profits in that compounding. So company selection is a good thing. Glad we talked about dividends, and kind of broke them down a little
yeah,
bit for everybody. I hope it was helpful and enlightening.
yes. I hope it was too. If you have any questions, please send them to us. You'll see our contact information in the notes.
Thank you for joining us on the Sound Banking Podcast. If you're listening on YouTube, make sure to like and subscribe and click on the notification bell. Otherwise, join us on Apple Podcasts and Spotify for more content.